Hey, good morning.
Hello.
Hey, and thank you so much for that generous gift. I really appreciate that. It means a lot.
You got it, bud. All right, you gonna co-host me?
Yeah.
It's from all of us 97 and uppers.
Yeah, I figured. And it was really sweet and thoughtful. And we are actually putting it to use today.
Good.
Yeah, one of my favorite restaurants, who also has been a client for kind of IT type stuff over the years, we haven't eaten from since the pandemic started. So we're going to order from there for tonight.
Good. Yeah, I checked out Hill Street, and they're on there.
Oh, okay. Cool. I didn't even think of that. This is the Morrison. It's the place that I've gone there often and taken pictures, of people I've gone there. Well, I think you went there with me when you were in town once. Didn't a bunch of us go there once?
Yes.
Yeah. All right, here comes Matthew. Good morning, Matthew. I'll make you a co-host. All right, and let me start going live on Facebook. Matthew, I still can't get that difference to happen in my webinar product, only on the regular meetings. I don't know why. One of these days I'll reach out to support on it.
I actually contacted Zoom and I asked them to make sure that you can never do it, so that way I can always beat you at one thing.
Perfect. You beat me at everything.
Is that your big motorhome, Greg?
That is not mine. No, that is my neighbor across the street.
All right.
Wish it were mine.
Me too. Well, actually, I wish it was mine, not yours. I mean, you can have one too, but it doesn't really help me if it's yours and I don't have one.
Well, it does if he drives it down here and picks us up and takes us around.
That's true. That was selfish of me. Please get one.
Yeah.
Good morning, Dennis. How are you?
Oh, there's the stretch. Tiffany.
So it says the webinar is now streaming live on
Webinar is now
Facebook.
streaming live on Facebook.
Tiffany, I can see the color now. It's purty.
Fixed.
That's what happens when you have a colorblind guy do your hair.
It took a few inches off too.
All right, almost there.
Everyone.
I'm ready for that.
You ready?
I'm starting to grow a mullet.
Oh, God.
That's not pretty.
I agree. It's now been deemed the California mullet.
Hey, all right. I think we need a little more light here. Let's try that.
And then there was light.
Let there be light. All right. Well, hey, everybody. Guess what? Happy good morning. It's Friday, August 28th, 2020. We are officially live. Good morning, everyone. I hope you're all doing well. And today's topic of the day is called Pandemic Cash Flow Strategies. This whole thing is inspired very specifically and entirely by a webinar I attended recently with Gene Marks, where he interviewed three people who were clearly very, had built up successful businesses. And he asked them questions about how to manage their cash flow in the wake of this pandemic. And one of the questions that stood out to me that I actually want to add to my notes right now, because these are going to go in the posted video when it's done for today, is what are you doing right now to protect your business over the next year? I think that is a really important question to be considering. And if you don't have a very specific answer to it, you need one. And I think if you're an accountant or bookkeeper serving clients, you need to ask them that same question, put it in the we form. What are we doing to protect your business over the next year? And if you don't have a specific answer to it, you need one. I think it's really, really important. It's one of those things that, and I think you're going to find that this is the theme of the entire morning this morning, is it's one of those things that's so obvious that we tend to ignore it. And that's the biggest mistake we make, is ignoring the obvious. Matthew says, we are pretending to be squirrels and stashing our nuts for a long winter. In a very solid metaphor, there's actually a lot of truth to that in terms of what we're going to do with cash, right? And that's one of the things I'm going to talk about. So, when Gene asked them this question, their answers were surprisingly simple yet powerful. And I say surprisingly because I think when we think of a topic like this, we're expecting, answers, things that are very sophisticated. And since that's what we're expecting, we overcomplicate these things in our own minds, and then we get stuck, right? Because we overcomplicated it, and we can't think, back ahead of that to what's the simple, yet powerful answer to what we need to do to protect our business over the next year. And the most powerful answers usually are simple. And it's in fact their simplicity that is a significant part of what makes them powerful, right? So put away your scientific calculator, right? And let's get ready to get down to brass tacks in terms of cash flow strategies, right? There's a few things that all three of the people that Gene interviewed were clearly agreed on, and they each sort of separately came back with their own versions of the same three things essentially. And it struck me how this was definitely a theme, and how each of these main answers were, again, very simple yet powerful and representative of the kinds of things that it's like. And these are, again, people who, from what I can tell, have built up very successful businesses. I believe that's why Gene selected them to interview them. And they all said the same thing. Like I said, just different versions of it. So there are three major themes that came out of their answers that I want to talk about this morning. Okay. The first one was, and this is what Matthew was sort of hinting at with what he posted in the chat about squirrels, it's hoarding cash. They all said you have to have a cash reserve, right? The second one was have a projection. Imagine, have a projection. You have to have that future look ahead for your business. And the third one, and this sort of came out afterwards, because what I did in classic Seth style was, as he was interviewing these people, I started stalking them on the internet, finding them on Twitter and LinkedIn and such. And I reached out to each of them afterwards and had kind of follow-up conversations with them. And I had some really interesting ones. And the third item that really was integral in their answers, but what one of them said to me very specifically in our follow-up conversation about it, they all agreed that, the focus should be on sales and marketing, right? And they all mentioned that a lot of times during a time like this, we do the opposite. We say, oh, the first place to cut back is on marketing. And they're like, that's the worst thing you can do, right? But that's where we think to cut back, because that's something we think of as discretionary, and it shouldn't be thought of as discretionary. In fact, at a time like this more than ever, it should be thought of as an absolute necessity. But the way the one woman put it, whom I spoke with as a follow-up, that I loved was, she said, sales solve (parentheses) most problems. And it's true. They solve most, not all, right? You might still have some HR issues and some other operational workflow issues, but sales, even when you have those kinds of problems, if you have sales and the cash flow that comes with those sales, you can probably pay for the resources you need to help solve those other problems. So it may even be fair to say that between the direct and indirect, that sales solve all problems, right? Sales and the cash flow that comes with it. So I want to break these down. Okay, and feel free, as always, by the way, to interrupt. I'm actually surprised how few people we have on today, given the subject matter, but it is what it is. People show up for what they need when they need it. And I'm on Facebook's live feed, and Kathy says, hi, everyone. I'm just popping in briefly during a break working in the food pantry today. Hope all of you are well. Hi, Kathy. And let's get down to business. Let's break these down. So first thing, hoarding cash, your cash reserve, right? Well, I remember one of my first clients, who was a very successful real estate investor at that time, told me, he said, you always need to have access to cash. And I remember that really stuck with me and struck me. And he was referring to the fact that, he had access to lines of credit, as well as, friends who would readily invest with him when he came across an opportunity. So even if it wasn't his own, he had access to the capital he needed to take advantage of the opportunities that would come his way. And the reason he was able to get the help of his friends is because they trusted him. They knew that he was very savvy and very smart, and that they knew that he was, he would work a deal. He would not buy a property at a price that was overvalued. You know, he would find properties that were undervalued, buy them, fix them up, and then turn them into very lucrative rentals. You know, I remember at one point he was going to sell one of these properties, and it was like all he had to pay on that property was the ongoing maintenance and a very low mortgage, because he had secured the note on the property many, many years ago, you know, long before the crash that we had in 2008. And I said, his name was Ron. I said, Ron, if you're going to sell it, I want to give me a chance here. I want to go line up, you know, I'm going to do what you do. I'm going to line up the resources to buy the property, because I was doing the accounting on it. And I said to him, I said, that thing is a cash cow. I said, I'm honestly surprised you want to sell it, but if you want to sell it, I want to buy it. And I was going to go figure it out. And I think, I believe, he never actually said it, but I believe that conversation I had with him made him think twice and made him decide to keep it, you know, because here I was, his accountant, telling him in so many words, you're crazy to sell it, but if you want to sell it, I'll take it. The only problem is I wouldn't have had the advantage of the extreme discounted note on the property compared to what he was paying, right? So that would have been, and it would have been such a loss. That was my whole point, is you have this locked in at such a low monthly mortgage payment. So anyway, you know, so his perspective was based on having access to cash, not necessarily his own. And this is good, but of course, having your own cash is even better, right? So everybody says, okay, right at this point, I know everybody's thinking it if they're not saying it. Okay, Seth, tell me something I don't know, right? But you know what the problem is with people saying, tell me something I don't know, is that they know it, but they don't do it, right? That's one of the biggest problems, is we know it, but we don't do it. So I am going to tell you something you don't know, because you might know it in here, but your actions suggest that you don't know it. Or I should say your lack of action suggests that you don't know it, because you don't do it. You don't take the action, right? And that's the problem. You know, we hear things like pay yourself first all the time. And we agree with it, and we think, yeah, that's smart advice, but it's the first thing we give up when cash flow gets tight, and it should be the last, right? That's the whole point of pay yourself first, is that should be the last thing that you cut from your budget. You know, you cut something else. You agree with yourself that you will forgo paying somebody else before you forgo paying yourself, right? And so I decided to do something about it, you know, some time ago. I sat down and to be very transparent, I'd had a conversation with my brother. And that conversation, you know, in that conversation, I got very open and transparent with him about my own personal finances. And we sat down, and he just kind of shone some light on some things that, kind of like what I'm discussing now, were just sort of obvious things that I hadn't been taking the action on. And so after that conversation, my brother inspired me to take some real action, and even worked with me a little bit, because it's one of those things that, yeah, I know what to do, but sometimes we need that push, and we need that outside perspective from somebody who's going to give us that kick in the ass and say, I know you know this, but you're not doing it. In other words, we need the accountability, which means we need somebody in our lives who can hold us accountable for this kind of thing. And who could I trust better than my own brother, right? You know, fortunately, you know, I trust my brother more than just about anybody else on this planet, you know, and I look up to him and have a ton of respect for him. So the first thing I did based on that conversation with him was I went on a bit of a hunting expedition. And if I hadn't had it already, I would have built the spreadsheet that I did have and started to use, which I referred to as a cash flow map. A number of years back, I did a video on this, and it really just lays out every expenditure that I have by payee, each payee in a row, and a timeline numbered 1 through 31 that would map out the exact day of the month that each thing comes out of the account, right? And what that did for me was it allowed me to really do some very specific and detailed cash flow planning, because in my case, my income was also very much set in terms of when it comes in, right? Because almost every payment I get is based on some sort of a subscription, you know, plus some one-off sales of digital products here and there, but it was very predictable. So it really helped me to see exactly how much came in on what day of the month versus how much went out, because, you know, otherwise the trap we get ourselves into is we get a whole bunch of money in at once. You know, like if let's say you're an accountant or bookkeeper who invoices monthly, right? So maybe you invoice on the first of the month and all this money comes in, and then you have to, you know, you have to spread that out for the remainder of the month if that's how your cycle goes, right? Mine was spread out throughout the month, but one thing that was interesting that I learned from putting this cash flow map together was, and it was just weird. I still to this day couldn't give you an exact answer as to why. I have some theories, but what I noticed was that a chunk of money for me would come in between like about the 1st and maybe the 6th or the 7th of the month. And then it was like nothing until about the 17th or 18th. And then from then till the end of the month, money would come in. So there was this like gap in my cash inflows that when I put this together, it gave me a lot of insights into, why I might at times feel like I'm being squeezed, because during that 1 to 2 week period in the middle of the month, not much money comes in typically, right? So so once I had this laid out and I could see that picture clearly, I went through it line by line and I looked at each item and I asked myself a very simple question: do I really need this, right? And in a column alongside to the right of that cash flow map, next to each line item, I started putting like X's next to the line items that I were maybe didn't need, right? And I would just kind of mark each one, like this is something I absolutely need, this is something maybe I need, maybe I don't, right? And then certain things I absolutely did not need, right? And and what do you call it? Wait, I lost my place here in my notes. So here's what happened. Long story short, after several passes through this on several different occasions, because I wanted to come back with a fresh mind a few times, I found about $1,000 in monthly expenditures that I was able to eliminate from my cash outflows, right? And mind you, about half of that was a whole life insurance policy that when I looked at the premium that I was paying for that portion of the life insurance and the cash value that had accrued, I figured out that if I had just put that premium amount into a savings every month for the same period, I would have had twice as much money without earning a dime of interest on it. So I said, well, this is a terrible ROI. The point of having it was that it's supposed to get invested in and growing cash value. And trust me, it was with one of the best insurance companies that I'm aware of on the planet. So, and they were supposed to have a very good track record. But to me, I could do a lot better by just putting that money away. So I surrendered whatever cash value was there, stuck that immediately in a money market. And then the next thing I did, and this is the important part that I want everybody to hear, because this is one of those things we all talk about doing, but a lot of people don't do it, is on the very same day that that portion, that premium came out of my account to get paid into the life insurance policy, I scheduled a recurring transfer for that amount into the money market account. And to this day, every single month on that day, that money gets transferred from my checking to the money market, and I don't touch it, okay? Next, I started paying very close attention to my cash balance, okay? Every day, first thing I do, just about every morning when I get here to this computer, I log into all my bank accounts and my Stripe and PayPal accounts so I can see exactly what I have and what's coming in, right? And the process of keying these numbers into a spreadsheet helps me pay attention to it. So no, just updating my bank feeds in QBO and running my balance sheet isn't enough. It's too easy to do that without paying attention to it. I can do that without even really noticing what I'm doing. And so there's no like sort of mental acknowledgement of what I just looked at on my own balance sheet, right? So it's having a separate process where I very proactively and definitively key in the numbers into a spreadsheet. It forces me to actually pay attention to what I'm doing and what that looks like. And then what developed over time when I started doing that, just about every day, not always every day, sometimes I can skip a day. Sometimes I can skip a few, but I don't go too long without doing it because it's important for me to maintain the habit and not lose it, right? But what developed over time is a clear sense of where my balance needs to be to make sure all of my working capital needs are met. And then I was able to identify a range. And I go over this a lot in my Bulletproof CFO program with my constituents who are there. And what happens now is anytime that my balance breaks through or reaches the top of that range, or breaks through, and especially if payroll has just come out, because that's always our biggest expense. So if payroll's come out and I check in the bank and I see all the payroll's actually been paid out of the account, and then I key in my balances and I see that I'm at the top end or over that range that I've identified is more than enough to cover everything, then I make a transfer. I basically sweep the balance down to its bottom end of that range because I know I have another couple of weeks for it to accumulate, and I know that it will based on my normal cash flow. And I move that into the money market. And mind you, that money market is in a separate bank that's hard to access. It's with Capital One, where yes, they have locations, but not a lot. It's not easy for me to go out and find a branch and go make a cash withdrawal, right? And of course, I can easily transfer it, to my main bank account. Of course, that's not hard to do, but the point is it forces me to stop and think before I ever do it. And to this day, since I started this process, I've never done it. I've only ever added to it. And I'll explain how that developed. So this is, first of all, this is how I very literally pay myself first, right? And here's what happens next. You start to realize that cash flow is not a reward. We often treat it like it's a reward. What happens? Money comes in, we do something extra or different, and extra money comes in, and we want to go spend it, you know, and we justify it. We say, I want to reward myself. I deserve this. I've earned it, right? So we treat cash flow like it's some kind of a reward for what we've done. But there's a reason why old money people sort of look down on the nouveau riche, right? The nouveau riche is a term that's used to refer to people who've recently come into a lot of money. And the reason is that when they come into a lot of money, they typically squander it, making sure that everyone knows how successful they are, right? And usually they go beyond their means. They buy a fancier car than they can really afford, and maybe a more expensive home than they can really afford. They want to make sure the whole world can see how successful they've become. But the real reward for cash flow is keeping it, right? And just like going to the gym or anything else that requires discipline, when you start to see the savings grow, you get more motivated to contribute to it rather than take away from it, right? Same thing with the gym. I start seeing results. I start losing weight. I start looking better, feeling more energy. That makes me want to do more of it, right? And the same thing happens with this kind of a plan and process, is that I want to contribute more money to it as much as I can, whenever I can, without depleting my, you know, my resources, my needed working capital, right? And I started asking myself a simple question, because you know, whenever money comes in, I still get that feeling of excitement, like, ooh, I should reward myself. It's kind of like ingrained in us, I think. And we even have programs that teach us to do this, right? They teach us to set money aside just for this purpose, which may be fine. But again, I would rather just, you know, put the money away. So I would ask myself, I started to ask myself when I started doing things this way, when I made this significant change in my sort of financial lifestyle, if you will, I would find myself on Amazon just looking around for something to buy, right? Or I would be on Best Buy's website, right? Or wherever. And I started to learn to ask myself, do I really need anything? And all I had to do was look around this very space where I'm sitting right now at all the little tech gadgets and my DSLR camera and my big ring light and all this amazing tech that I have right here. I have this really cool vintage Bluetooth speaker, you know, so I can have beautiful music playing in my office all day long. There's nothing I need. There's not a single thing I need. There's a lot of things I could want, but there's nothing I need, right? And that gives me the pause I need before I go reward myself by spending money. And instead I can, you know, I can make another transfer into the money market account, right? So in other words, when I ask myself that question frequently, do I really need this? The answer is usually no. And now more than ever, I update my bank balances and think about how much I can transfer into the savings every day. Because again, having a very sort of specific and physical process like that forces me to pay attention to it. Looking at a balance sheet never really worked for me, at least not for that purpose. And if you struggle to see your cash flow reach any kind of a range where your bills are paid, stay tuned, because I've got something for you on that, right? Okay, and so that brings us to the hoarding cash part. That's what all three of these business owners said, is we have to hoard cash. We have to put it away. Like Matthew put it, you know, we have to be squirrels stashing our nuts for a long winter, right? Profitable sales solve most problems. He even said it. I don't know if you said that before or after I said it, but either way, good stuff. So, hoarding cash. And it was interesting to me that they all said it in their own different version, their own words. But that was like the first thing each of them said. You know, you got to have a cash reserve. You got to build it, right? You got to pay yourself first. And you got to forego paying something else before you take away, you know, whatever amount you've decided to pay yourself. I know that each month, if I do nothing else, that one transfer I set up recurring every month is going, right? It's not, I'm never going to cancel that. I will not pay my mortgage for a month before I cancel that payment. I would take it that far if it came to that. I would skip a mortgage payment before I skip that. It's that important, right? Trust me, I've had the experiences where I've been faced with that sort of decision of, if I lose my house, it'll be okay. It'll be a big burden off my shoulders, actually. I won't have this payment to make every month. I can probably easily find a place where I can live like a king on a fraction of what I pay to live in the home that I live in today, right? So it took me a while to come around to that way of thinking on it, but there was a time when I reached that way of thinking on it, and it's never changed. And I honestly stopped concerning myself too much with what my credit score was, because the only reason I need a good credit score is so that I can borrow money, which is something I never want to do if I can avoid it. So, hoarding cash. build your cash reserves. That should be your first priority. Next, have a projection. Yep, plain and simple, have a projection. And from where I sit, that means a complete set of projected financials. And so I want to share something with you. I'm going to share my screen in a second. This is something we built actually in 97 and up at the beginning of COVID, or started to, and I use it as part of an exercise that I do in the Bulletproof CFO now. I'm going to give you the same walkthrough I give people in my sort of introductory call when I'm, on a call explaining about the Bulletproof CFO program to people, all right? So this is just a sample financial model that we built. It's a projection. It's exactly what we're saying that you need to have. It's exactly what all these three people said they need to have. And it was interesting to me. They all said that they have them in spreadsheets. And of course, as you're seeing, this one's done in Google Sheets, which is not bad for open source stuff. Right, Matthew? Yeah, I see that smile. So here's an example of just some simple drivers. What are drivers? Drivers are going to be sort of variables that we use in calculation. So you can see I have my Social Security and Medicare rate, and we have the phase out, and I have an AR turnover, saying that we're going to assume it takes on average 45 days to turn over accounts receivable for this company. Of course, there'd be many, many more assumptions or drivers in here as the thing gets built out. But this is just to give you an idea, and you're going to see as I go further into this exactly how those factor in, right? Then we have a profit and loss, and I know you all know what a profit and loss looks like, right? But it's important just to see that, we lay this out in a timeline. The shaded months are the months that were presumed to be historical at the time this was built. And of course, at the time we were in the month of March, so that was still a projected month and so on, right? So there's always going to be little visual cues so I can clearly see what's historical versus what's considered to be a projected number, right? And again, these are just fake made up numbers, of course, right? I mean, look at this huge jump in sales from 15,000 a month to 265,000. We did something right in March, right, in this model. But then we also, probably in order to do that, we had to hire some people to make that happen, right? So all of a sudden we have 80,000 in salaries to generate 265,000 in revenue. And this is how I want you to start learning how to look at this kind of stuff, right? Is what story does this tell us? How did we get the 265,000? At least form a hypothesis and then go, it's the scientific method, form a hypothesis and then go confirm if that's really what's going on, right? So anyway, P&L. Now we have some schedules that we'll build that are meant to flow back to, for example, the insurance line item here, right? So let's take a look at that. If I go to my insurance schedule, what you can now see is how I'm able to cash flow any line item on the P&L like this. And I can break it down into details. I have an umbrella policy, a key employee, which is just life insurance for the officers of the company, general liability, and auto. And I can cash flow it based on how those premiums are paid out. Because some of them are paid out, monthly, like the auto. Others might be paid out, so many months. And what this doesn't take into account, and it doesn't necessarily need to, because the purpose of this is cash flow, not accrual accounting. But so it doesn't necessarily take into account like prepaid versus amortized, but you can easily build that into this. I've done it before in these kind of models, right? But you can lay this all out just like this. And of course, this total is going to flow back to the P&L here, right? And so I noticed there looks like some months were missing here. So let's just go in here to March and I'll say equals, and I need the total for March from this schedule. So I just click there. It's about as easy a formula as one could write in a spreadsheet. And I'm just going to copy that across, because as I copy that across, it's going to update the reference accordingly. And so it's always going to pick up the applicable month when I copy that across. So now my insurance line item is fixed. And of course, that's going to roll down to net income, which, as you'll see in a few minutes, rolls into cash flow. Okay. Now, I just create a template. Once I build the first schedule in a model like this, I create a template. I just kind of gut it out and a blank template. So the next time I need to build a schedule for anything that's going to flow to the P&L, all I have to do is duplicate this tab and then start building it and then write the formula over on the P&L that ties to whatever total I'm getting at over here. Very, very easy to do. Now here's where it can get a little more complicated, is in a payroll model, right? And so here, using the example of an S-Corp where we may want to group salaries by department, I teach how to use a SumifS formula after we've got all the salaries laid out to regroup it based on, the officer versus the staff. Of course, this is going to flow to the officer salaries line on the P&L. This is going to flow to the regular salaries line on the P&L. And this always has to add back to the same amount as this. It's a double check to make sure that, it should be the same total wages. I'm just grouping it a little differently here. Here it's by employee, here it's by department, right? And then over here, you can see where I pulled the 7.65 over from the Social Security and Medicare assumption that's on the drivers tab. I bring it in here for presentation purposes. I may know how that's being calculated, but the business owner that I'm preparing this for may not. So I just bring it over here for presentation purposes and show that it's basically going to be a function of the 7.65% times the total salaries for that same period, right? And then we get down here, and I showed you how we had the phase-out assumption, right? So here's where, using just the example of one of the employees, in this case, Greg, I showed how when it crosses over that threshold of 120,000, you can see, and this was me just playing around and testing something here, you can see how here we cross over 120,000, so we have a partial phase-out in that month, and then a complete phase-out in all the months thereafter for the rest of the year. And when I built this, we also discussed the fact that leaving this assumption out of it would be conservative, if anything, because it would assume more payroll taxes paid than actually were, so that it's this way we're overstating the expenses, which for cash flow purposes is a good thing. So there is the option of ignoring something like this and not factoring it in. The nice thing about having it is that if the threshold were to change, let's say this year they said, hey, we're not going to phase it out until we get to 130,000. All I have to do is change the driver here. And when I go back over to payroll, you'll see that it doesn't begin to phase out until the following month, right? And a different partial phase out, of course, and then the complete phase out doesn't change, okay? So that's what a payroll model begins to look like. Next, we have a balance sheet. And the balance sheet, again, I know you know what that looks like. The important thing to consider here is that we do a balance check. What this does is it takes the total liabilities and equity and compares it, of course, with the total assets. This always has to be zero, which on a historical period, it should, because we're exporting that from QuickBooks. And I know that all of us here have probably seen situations where the balance sheet from QuickBooks didn't balance, but by and large, most of the time it does, and it certainly should. But the main purpose of this is when we get into the projected periods, if something is off in our projections, if something is off in a formula somewhere, we'll find it because this will be off, right? This will not be zero down here. So this is an important check that we add into the model to make sure that the balance sheet is always in balance, okay? And then, of course, we have a template for a balance sheet account, which differs from a P&L account in that it has a beginning and ending balance, right? And then we can see an example of what this looks like. Here's a sample distributions account model, right? Where what this does that's really nice is it gives us the ability to be detailed and say, let's plan on a monthly distribution. And this is one of the first things I go over with clients when I do this is I say, look, you're all over the place, because they usually are, in terms of what you're taking out of the business. And instead of doing that, we're going to normalize this. First we have to make sure we're paying you reasonable compensation if you're an S Corp, but then I know you're also going to take some distributions. So we're going to normalize this. We're going to get consistent, because if we're going to do projections and forecasts, we need predictability and we need consistency, right? So we do that, and then we can also build in a tax distribution and say, hey, you know what, come September, we're going to need an extra chunk to take out to pay the taxes, right? So we build that in, and that gets cash flowed, and you're going to see exactly what that looks like in just a minute. In fact, right now. So here's your projected statement of cash flows. Now on the balance sheet and P&L, I said I know you all know what this looks like. But on this one, some of you may not know what this looks like, because this one is the one that tends to get ignored, and yet it's so incredibly important, right? You can see the distribution impact here. Remember, this is cash flow. This is not balances. So notice it shows his 5,000 that's coming out each month, and then boom, here's 105, because in September we planned that extra distribution, right? And then finally, for now, we have a debt service model. Now, this is where this can become a really powerful planning tool, because we list all the debt instruments. And if need be, I can add in a line here. If it's a line of credit or something revolving in nature, I can add a line item here that allows me to plan for borrowing. So if I know, for example, that we're going to want to stock up on inventory going into the holiday season, I can plan, and we don't have the cash to cover all the purchasing that we need, then I can plan the borrowing of whatever amount of money we need, because back here on the statement of cash flows, I can see if and where I might be running tight on cash. Notice the ending cash balance is nice and big. I want that to stand out very clearly. I'd usually color code it too, because I want a lot of attention on that. So in this case, we clearly don't need to borrow any money. But if we did, we could see that looking out into the future here. This is where you get a planning tool. And this is what allows me to say, hey, let's assume a slash in our revenue base based on something like COVID. And let's see what that looks like in this plan and how we can weather that storm. And going back to the debt service real quick, if we plan the borrowing to stock up on inventory going into the holiday season, we also want to be able to plan the repayment immediately after the holiday season, because every dime of interest that we pay on that borrowing after we've already gotten out of the period in which we're selling that inventory that we stocked up on with that debt, every dime of interest we're paying on that now is eating into our profits effectively that we made from selling that extra volume of inventory. So the point is we want to get that paid off immediately after, so that we're not, sort of defeating the purpose of what we did in the first place, which is to make some extra money. There's nothing wrong with borrowing if there's going to be a good ROI on that, especially, right? So this is where this can become a really important and powerful planning tool. I know I kind of whipped through that quickly, but I just want you to get an idea of, what a projection, what a forecast really does and how powerful it is. And by the way, yes, we do this with Giraffe, but what I teach in Bulletproof CFO first is how to do it this way, because if you know how to do it this way, then you'll really know what you're doing when you get into a product like Giraffe to do, cash flow projections there. And of course, Giraffe saves us the heavy lifting. And it's the same process. That's why I love Giraffe. It's the first product I've run across of its kind where it gives me the same level of flexibility that having a spreadsheet does, where I can go in and write and tweak my formulas to predict cash flows in the exact manner that I want. Most other things let you use very sort of generalized assumptions about, what you can do, but they don't let you get as specific as a spreadsheet. And Giraffe does. Giraffe gives you a driver module where you can literally set what your variables are and write the formulas, and you can pull from any line item on the balance sheet and P&L to calculate an amount for a line item somewhere else, right? And I've built complex debt service schedules in Giraffe. Not easy to do. There's a learning curve, no question. But once it's done, it's beautiful and it works. And if I need to change an interest rate, I can change an interest rate and boom, the model updates. It's beautiful. I'm looking at the chat now. So Matthew says, real question, how do I take into consideration the opportunity cost of capital, having cash on hand while creating projections? So it is a really good question, actually. What I will say is, yes, if you accumulate too much in cash reserves, then the money's being wasted, right? But the first step is establish a threshold. How much do I need? My therapist once asked me this question when I was complaining to him years ago about, how hard I work and how many years I've been doing this, and I still feel like I don't have nearly enough to show for it. And so he finally stopped me. He says, Seth, tell me something. He says, how much would be enough? What amount of money would you need to have in the bank for you to be comfortable, for you to be able to say, you know what, I'm good, I'm not worried anymore? And I thought about it, and I gave him a number as kind of a first threshold. And I remember when the day came that I reached that threshold, that I had that much in my long-term permanent savings, free and clear. And, it was a very exciting day, actually, when I went over it with him and we reflected back on that conversation. And it was so important to me that I knew what that threshold number was. And I'd say the same thing is true for a business. And going back to Matthew's question, that's the first thing we need to know is how much do we need to have, available in cash at a minimum to know we're okay. Right? Then once you've established that kind of a threshold, then we start, like I said earlier, carving out chunks into savings. At a certain point, though, we want to invest that savings somehow, some way. A money market's going to pay, I think it's barely 1% in interest right now. It's gone down. When I first opened my money market a couple of years ago, it was like 1.5%, which is still bupkis, but it's something, right? It's better than spending it on. It's better than giving it to Jeff Bezos, right? He's got plenty. They just wrote him up the other day. I read an article. He's the first person in history to be worth $200 billion. I don't need to give any more money to Jeff. Jeff needs to give me money, right? I've sold a lot of his products on his website. Anyway, joking aside, we need to establish what those thresholds are, and then we need to find ways to invest that money well, right? Now, theoretically, there should be some things you can invest in terms of infrastructure in your own business to help grow and scale that business, right? You can always scale up your marketing and advertising. If you have that kind of excess cash sitting around, that's the first place you should look, is to scale up your marketing and advertising spend, right? If you follow anybody's teachings about how to build a funnel a sales funnel, right? They're all going to teach you the same basic thing. You start off with a minimal advertising budget so you can test things. But once something pops, you just jack up the spend, because while it's working, you ride that wave. And theoretically, if it pops and it's getting results, jacking up the spend is going to cause those results to increase exponentially, right? So that's, I think, the first and maybe the best answer, Matthew, I can give you on that is establishing that threshold. And then once you go beyond that threshold, the first thing you should do is carve it out into marketing and advertising and building that sales funnel, because remember, sales solve most problems, right? So that's the first thing we want to do, is build up that sales base, because then if that's working and it's working well, guess what I have the money to do is to hire people to support the extra business that's coming in, and I can pay for the resources I need to build the infrastructure. And nobody that I know on this planet knows better than you, Matthew, how to also focus on keeping things lean and efficient, right? That's always, we should never forget that exercise of going through the expenses. Once we slash things, we need to keep it that way. And sure, I took some things out that I've since added back, because now I had the cash flow to support it. So it was, I could justify it. I can afford this now, right? And what it's also done, by the way, is providing me with some real freedoms that I didn't used to feel I had. A lot of you have probably noticed I've been posting a lot about how much fun I've been having hiking and flying my drone, right? In other words, the financial security that I've been able to create for myself around this kind of a process has given me that freedom to spend money on a hobby that's not cheap, but that I love, that gets me out of the house, away from this, right? Doing something that I really enjoy doing, spending some good quality time alone or with friends, right? Doing something that's really healthy for me. And then the payoff, of course, is that beautiful footage I get from that drone that then I get to geek out on when I do come back home to my computer. And it's not work related. I'm not really using that footage for business purposes. I'm just using it just for fun, just to say, look at this beautiful view that I was able to capture. What?
I am.
I know. But you get my point. It's not the primary and original purpose of it. I mean, of course, I'm going to build it in and justify why it is a business write-off, because I am going to use the footage for intros and things in my videos. And I've already used drone footage as a kind of metaphor in some videos where we talk about elevating our business, and you just have a view of the drone rising up. There's lots of things of course, we can get creative. But my point is that when we create this kind of financial security for ourselves, it affords us the freedom, right? And it's the freedom that's so important. The freedom that comes with knowing I have, what my therapist refers to as an FU fund, right? And what he means by that, and there's a great blurb from the remake of the movie The Gambler with John Goodman and what's his name? Is it Mark Wahlberg who's in that one, or is it I forget who the other guy is, or I think it's Matt Damon. Either way, he gives this speech. It's called Living from a Place of FU. And it's basically about how, the American dream is you set yourself up, maybe the Canadian dream. I'll bring my Canadian friends into it. I don't know what the Canadian dream is. I always hear the phrase the American dream. I never really hear Canadian.
It's nicer than the American dream. It's much nicer.
It's much nicer. It's much more polite.
And there's maple syrup involved. So.
Definitely. So the idea is you set yourself up, because when we're desperate, I'm not saying you, but when people are desperate in general, they'll do desperate things to make money, right? I learned a long time ago working with a business partner that I had many, many years ago. And he was a mentor in many ways to me at the time, that you never want to hire somebody to work for you who's desperate, because they're going to do desperate things and it's going to affect your business, right? They're going to make bad decisions behind that desperation, right? So on the other side of that, when I have the security that comes with having plenty of money, I have the ability, when somebody comes to me and tries to entice me to do something that's less than savory, or just otherwise just not a good idea, I have the freedom to easily and instantly just say, F you, go away, leave me alone, I'm not interested, right? That's what he describes. Of course, I'm trying to keep this PG-13, so I'm not using the language that he uses, but go Google it. You'll find the video. It's really powerful. So have a projection, right? That's how you literally put the plan in place for how we're going to get from where we are today to where we want to be tomorrow, right? That's plan A. Plan B is Matthew's plan. What do we do now that I have all this money? What do I do with it, right? First, we need to make sure we have what we've established as a threshold that we need at a minimum to be okay. Then after that, we need to be investing the money, right? Growing and investing it back in your own business. Matthew.
One of the things I put in the comments earlier was I found, at least in my own business, it's very easy when we first get into business and we're struggling through to try to make it on our own, right? And do this and do that. Things can be very tight. It's easy to forget all the little incremental changes to the quality of life we have now over time, which we didn't have before. And those incremental changes are one of the biggest, they suck cash flow faster than anything else sometimes.
Mm-hmm.
So, and they also tend to not be appreciated the same way as if you really recognize like a pay increase. So during times like this, it's important to kind of reflect back. It doesn't mean you have to change it, but acknowledge it, figure out what your standard or your basis is again, reestablish that basis. And if certain things can be reduced to help cash flow, it's good, but reestablish that basis and start that moving forward also.
Yeah. And I guess, more to your point, whatever you establish as that initial threshold, that's going to change. It's going to increase too over time, right? And one thing somebody told me a long time ago that's a great sort of strategy around cash flow, both personally and for a business, is, you establish that threshold, and then let's say you get 10,000 over that threshold, you carve that out and invest it into something, right? Then you build the base threshold back up till it's again 10,000 over, and you shave that other 10. So you're constantly maintaining that threshold, but every time you get 10,000 over, you move it over into whatever fund it's going to be used for, so that you have a plan for reinvesting. And then, what I did was I established what that threshold was, and once I got there, I doubled it. I said, now that I've got what I feel like I really needed at a minimum to be okay, by doubling it, because at the rate I was going, I knew I could double it and hit that threshold again pretty quickly. So I did that. And, so the idea was, now I'm whatever I thought was comfortable, I have a lot of extra cushion now, right? When I hit that second threshold, and now I really start thinking, okay, I'm going to dump money into it. And the other thing is, and I'll be transparent about this. When I initially launched the Bulletproof Bookkeeping course last year, it was a big revenue generator for me. In the beginning, I was sort of pre-selling it at $500 lifetime access for people who were willing to sort of take a chance with me while I was developing the course, and getting into it before I was, let alone before I was even finished with it, as I was just getting it started, right? But by September of last year, it's been almost a year since I did that release party. It had generated quite a bit of revenue, and especially when when the impending threat of me doubling the price to 1,000 was there, a lot of people jumped in to take advantage of it. It's now $2,500 for the course, right? And I had said from day one that was the target price of it, but I was going to increase it slowly. But what I'm getting at is, by the end of September of last year, it had generated quite a bit of money, and what I did was I took about 10% of what it had generated and invested it into a marketing program, so that I actually did exactly what we're talking about. And that marketing program has now taught me things that have enabled me to, I don't know, I haven't honestly looked closely enough yet, but at least triple what it had done by the end of last year. It's done well, and then I launched Bulletproof CFO as the kind of follow-up high ticket program. And you've just gotten a little bit of a taste of what that's about. We also go into selling and how to really build up an accounting business vertical based on offering these advisory and forecasting services, right? So that's done really well. So that's the point. That actually illustrates the point. I'm not just saying this stuff, I actually practice it, right? And Matthew, going back to your comment, I know you're kind of joking, but it's probably a real question about like paying the mortgage. The thing that I think a lot of people fail to consider that's very important is whatever paycheck I'm drawing out of my company needs to be sufficient to pay that mortgage and everything else. And a lot of times when we build these forecasts, we forget about, when we get to that line item of what the officer is taking out in salaries, maybe plus whatever the distributions are, assuming we have the right balance there and we're doing everything appropriately. Still you have to add those two numbers up and say, is this enough to cover? And so I go to my business owners before we start the business projections and say, I need you to give me, I said, I know this is personal, but it's important. I need to know what your living expenses are. I need to know that because if we're not able to take enough money out of the business right now to cover all your living expenses, I need to know what number we need to get to as quickly as possible, because I need you comfortable there so you can be focused on your business. That should be the first priority, right? Is if we're not there already, getting to a place where I don't want my business owners distracted by the worries that come with knowing that their business isn't generating enough for them to pay their own personal bills, right? That has to be the first priority. I've seen so many businesses, I'm sure you have too, where the owner just doesn't even take a paycheck. And that gives us a very skewed picture of how that business is performing. It makes it seem like it's much more profitable than it is, because that officer's salary is a necessary expense of that business. And if it's not being paid, then the business is not solvent. That's the bottom line on that. Okay. Last but not least, sales do solve most problems. Simple and true. If you're struggling with cash flow, with what I suggested previously about slashing expenses and the things you don't need, or the ROI isn't there, if you do that first when you're struggling with cash flow, then there's only one thing left to do after that, which is focus on sales and marketing. And the only unacceptable answers here are the ones that are based on what you can't do. Okay. Now, I'm going to post a link to a YouTube video in the chat. Don't watch this now. Okay, but all of you have homework. I need you to watch this at your earliest possible convenience today. I forget how long it is. It's not more than 10 minutes. It's actually, I think, a lot less than that. It's a video that Hector brought to my attention from a guy named Casey Neistat, who I had followed for years, but never had come across this video for whatever reason until Hector showed it to me. It's called "Do What You Can't." And I would take it a step further and say you should watch this video every day at some point early in your day. If you need to get pumped up, if you need motivation, if you need to get inspired, this is the video. It's called "Do What You Can't," because so many of us get stuck on this concept of, oh, I can't do that. Oh, my client can't do that. It's COVID. They can't make any money. They can't generate sales. They're a restaurant. They can't bring people in, so they just have to close down. Bullshit. You know how many restaurants have been very successful during this time by getting creative and offering takeout and other services? I have so many examples right here in my own backyard here in Burbank, right? So I don't accept that. Anything along the lines of I can't is unacceptable. Everything else is acceptable, right? So the next time you find yourself saying, I can't do that, I want you to stop right there and focus on what you can do, okay? You can be creative. Matthew says can't is a 4-letter word. When your clients tell you that they can't pay you to do their books because COVID, your answer should be something like this. And I'm going to read this right out of my notes, which again will be provided when I post up the recording this weekend. But when they say, oh, I can't pay you for your bookkeeping, your answer should be, are you kidding me? Not only do you need the bookkeeping more than ever, but we need to put together a projection so we can figure out what you need to do to weather this storm, right? We need a clear and present look at how we can navigate a hit in sales and then rebuild our sales models based on something that is pandemic proof. That should be your answer. And then you should turn it all around and say, let's schedule a Zoom call so let's do a strategy call. Let's figure this out. Right? Now, some clients will probably come back and insist, you can't, I can only lead somebody to the water, right? I can't make them drink. Okay. And of course, it's not easy. Nothing worthwhile ever is, right? But it's simple, right? Get and stay focused on this one principle, and everything stems from here. Sales solve most problems. Have an absolutely fantastic day, everyone. And of course, if anybody
Profitable sales. That is so important to say because it is so different than sales. Sales where you're losing your rear are not, that doesn't solve any problem. Profitable sales.
I want to qualify that
profit.
though. I want to qualify that though, because it's positive cash flow that we need. We can be running at a loss. We can be running in a way that's not profitable, but if we have positive cash flow, we can still survive for a while. The first step is getting the sales in. You can always figure out the profitable part after if for some reason you're not. So, and again, I don't want to bog people down by overcomplicating it because that was my whole point. We want to keep it simple. So step one, just get the sales in, and then we can figure out the profitable part if it's not already profitable. Right? So, and then that goes back to, KISS, keep it simple.
Which is another 4-letter word.
Keep it simple, KISS. All right, anybody else? Anything else? Comments, questions, thoughts? All right, then. Well, then I will leave you with that thought. Sales solve. And that's also why we say most problems, right? Sales solve most problems. Remember it. Watch that video. Casey Neistat. Do what you can't. right? I'm telling you, I would play it now and I could share it in a way that the sound would play, but then I'd be putting somebody else's copyrighted material into this video. I thought about that. I was going to make you all sit through it with me, but I can't do that for the copyright reasons. I would love to. So I'm counting on all of you to do this on your own. It's really important. And on that note, I'm going to bid you all an absolutely fantastic weekend.
Farewell.
Bye, guys.
See you, nerd.
Weekend. When's the next squirrel nerd?
Oh yeah,
Sunday. We're going to
Squirrel of the
a little
week.
earlier. Squirrel of the week.
Squirrel of the week. Beware.
Nerd way.
By Nerdway. Good job. Thank you, Tiffany.